Welcome to the Half Empty, Half Full Consumer Advocacy Radio Show. Listen in nationwide on the Tan Talk and Starcom radio networks with your host, Lori Zook, the consumer champion. Each week, we'll be discussing problems and solutions, changing negatives to positives, and helping you, the consumer, to learn something new. Get smarter faster and avoid scams and fraud. All opinions are that of the host and guests, and all shows are for educational purposes only and not to be construed as legal advice. Here's your host, Lori Zook.
Welcome to the show. My guest today has been here a few times before. One of my favorite guests. It is Andy Feinberg. He is the CJA hedge fund manager, and he's also Kiplingers columnist. And we're going to be talking about what you as a consumer need to know about high investment fees, because you might be paying more than you think. So I want to welcome you back to the show, Andy. And again, if you'll just share with our listeners a little bit.
Be with you.
Thank you. Yeah, just give a little bit about yourself and your background.
Well, I've written about personal finance for, it's going on 40 years now. And I have been a money manager for 14 years. So managing money was my hobby, and it became much of my life. But I still write a column for Kiplingers. I've written books about personal finance, borrowing money, investing money. So that's my main area of concern, and as a writer and as a money manager.
Yeah, you write a great column. I found you about a year ago. I think it was Swimming with the Sharks or Swimming in a Cesspool. The
Yes.
Wall Street story, right? Yep, that was excellent. Well, we're going to talk about the high investment fees. Now, I don't know a lot about this topic. I've come up with a lot of questions. Tell me, what types of investments do fees apply to?
Well, they basically apply across the board. I want to start with a story, and this happened about 10 days ago. Someone who read my column called me up and was asking for advice about where he should take his fairly ample nest egg. There were two large brokerage firm, household names, sort of vying for his business. So he told me the returns of the different places, but I asked him, well, if you moved it all to Morgan Stanley, what kind of fees are you paying on the funds? And he said $95. Which couldn't be the right answer. That must be some kind of annual fee per fund, because what I was trying to get was the fund charging 1.5% of assets per year, 1%, half of 1%, and it's easy to get. But this is a man who was sophisticated enough to reach out to try to get help, but he didn't know. He knew the performance. And basically every study has shown that lower fees over time beat higher fees, all else being equal. And the amount can be so enormous on a $200,000 nest egg over a lifetime. A 1.25% annual fee differential, a 1.25% fund versus the cheapest index fund, which is next to zero. It's $570,000 is the difference with what you would have accumulated over a lifetime. And so it's almost 3 times the amount of the nest egg you started with. And so one thing I hope your listeners come away with is to know how important fees are and to find out what the fees are with everything they're doing. One of the great things that's going on in the country right now is a lot of investors are doing this. Some of it's driven by the outperformance of index funds over active funds. But even on the side of that, people are just going, wait, you're charging 1.5%. That's too high. I'm going to move to another fund that Morningstar likes with fees half as much, because I believe the idea that over time lower fees will serve me well. And they really, it's not that I want everyone to be in an index fund necessarily, but to start with that idea that and Vanguard index funds are cheaper than everyone else's index funds, and you can pay 1% for an index fund some places, and At Vanguard, you can get it as low as 0.05%. So, and I have no relationship with Vanguard, except I think they're a quality outfit. So it's, so I told this gentleman who called me to find out how much was going in fees, because that should help him understand how good a job his advisor was doing. You know, if you look at, if they're high fee funds that don't beat the market over time, you know, what are you paying those high fees for? You don't have to.
No, but I think it's confusing though to people to read. I mean, it's almost like when you close on a house and you sign an inch stack of documents that, you know, who's reading it. Well, when you have these investment fees, is it easily do the people that are the investors, is it easily disclosed? Is it hidden in? Is it, you know, like a credit card statement where you look at it when you get your statement and you understand it? Because I think that's a big part of it.
Well, I would say it's half and half. It's almost never disclosed by the person selling the and later we're going to talk about, you know, other things that planners can sell, insurance or annuities. Whenever someone is selling you something, they seldom mention, you know, what their commission is, if there is a commission, and they are seldom mention the annual fee, like annuities, for example, have very high annual fees. They have some benefits, but so if it's a mutual fund, you can maybe before you buy, ideally, look up on Morningstar or other services what they will tell you on the first page what its, you know, the fee is, the annual fee. Where it gets a little trickier are the load funds, which have an upfront sales charge, and then some of them have an annual fee. Some of them have an annual fee which may go away after 5 years. And I would caution people away from load funds. They're the most profitable for the broker and the brokerage firm. So there you have to, you know, you've got the A shares and the B shares and the C shares and the D shares, and you have more fine print to wade through. But I would hope some people would take away that they don't even want to get to anything that has so much fine print if they don't have to.
Right.
And mutual funds, I don't think you have to.
Yeah, I mean, it's confusing. I mean, your fees, is it a set amount? Is it a commission? Is it a percentage? And, you know, I'm thinking if you are seeking out, and we're going to talk about fiduciaries in a little bit, but if you're seeking out someone to help you, I would think the first thing I would ask is, what are your fees, and how do you determine your fees? But I don't think people ask that.
Right, and the man, well, there are two separate questions. The guy who called me, I suspect that the fees, like the checks he has to write, are almost nothing to this broker. That the money the broker and the firm makes is on the sale of these mutual funds. So he was confusing like a fee that you would pay, you know, a lawyer or something, or what you'd pay to get a mortgage. And so some of this is insidious because you don't see them, and it's not discussed. So it's not as if, you know, if you went to a lawyer and said, you know, I charge $1,200 an hour, you might go, well, that's fine for someone else. I'm not paying $1,200 an hour. That's crazy.
Right.
And I think I can get good service for $250 an hour or whatever the price is. It's not the same kind of conversation, and I think that's one of the places people get in trouble because they're used to having these it's not an apples-to-apples conversation. It should be an apples-to-apples calculation that you eventually make, but you sort of have to say, okay, what are we agreeing to here? And you have to figure out how they're getting compensated. And,
but that's crazy. I mean, I'm thinking there should almost be a disclosure sheet that they should be required to give you before you sign for anything that says, here is my annual fee. Here is the, you know, if I'm trading for you, here is how that part of it works, so that you actually know what it is.
Well, I think that would be great, and I think especially here are the different mutual funds or mutual fund families I sell. One of the mini scandals used to be that, and Morgan Stanley, interestingly, was involved in this several times, that brokerage firms make more money when they sell their in-house mutual funds. And so this sets up a tremendous conflict of interest between a broker and the customer, and sometimes they get these incentives, sell more of the funds and you get a trip to Hawaii. And Morgan Stanley was told to stop this, and then they kept doing it. And so there was just a study, and people have to think of this. If there may be some very good Morgan Stanley funds, and there may be some very good funds at different in-house funds, but beware if they're directing you to one of those that they are making more money on those and their employer is making more money on those. So there better be a reason for you, as in good performance, or it provides a kind of diversification that you can't get easily with other funds. There was just a White House paper which came out in February, and it said the cost of conflicted advice, and conflicted advice, it means where the broker or planner will make more money if you buy product X than product Y, and they are likely to recommend the more expensive one, costs investors $17 billion a year, or 1% a year of the assets involved in their study. And that's $17 billion that customers are losing. And it's just that if they went to the other index fund, the Vanguard index fund, instead of I'm picking a Morgan Stanley, instead of the Morgan Stanley index fund, since it's the same index, but they may have different fees. And the advisor, in some cases, is he may be friendly, but he's not necessarily your friend because he's making
money. I mean, it's the Wolf of Wall Street analogy. I'm going to ask you just to hold on for one moment. We're going to go to a quick break.
Okay.
Our highly competitive and hectic world is fraught with dishonesty and challenges. Critical decisions must be made on a daily basis with accuracy when substantial assets are at risk. When you are confronted with a decision point involving opportunity and risk, consult with Sharpline Investigations, statewide experts in due diligence, investigations, and litigation support. Sharpline's professionals work with clients to conduct interviews, deep background investigations, and develop facts and intelligence related to litigation. When circumstances require confidential and expert fact-finding, turn to Sharpline Investigations, the statewide leaders in investigations and risk mitigation. Visit sharplineinvestigations.com or call 855-394-0042.
Are your credit reports a mess? Are debt collectors hounding you? Maybe you're in foreclosure or headed towards foreclosure and don't know where to turn. It's time to stop panicking. Take back control of your life. Make the first step by calling Credit Education Consultants today at 813-500-6064. That's 813-500-6064. Mention the word radio for a free 15-minute consultation. Don't delay. Call today.
Do you suffer from back, neck, or body pain? Do you suffer from migraines or have jaw or face pain? Has conventional medicine failed you? Were you injured or in an accident? Call chiropractic physician Dr. Dan Maddock at 813-935-1664. Dr. Dan has helped thousands of patients gain relief for more than 30 years. Dr. Dan is caring, gentle, and takes his time with each patient. He's also a past president of the International Craniopathic Society, a special certification of only 300 chiropractors worldwide. Dr. Dan helps patients from the neck up and the neck down. Dr. Dan accepts most insurance plans. Don't continue to live in pain. Call 813-935-1664 today. That's 813-935-1664 and get on track to better health.
Welcome back to the show. We're talking about investment fees. Are you paying too much? And my guest is Andy Feinberg, great finance guy. Andy, we were talking in the last segment a little, I was giving the analogy, you were talking about the Wolf of Wall Street. You know, people who are making more money because the majority of us don't understand how investments work and what the fees and the commissions are. So on the commercial break, Jeff here, who's the studio manager, said to me, why don't you ask him what are the questions to ask from start to finish with a broker? You know, is there a checklist? And what do you do if they don't answer those questions?
Okay.
That's a lot.
Well, if they don't answer, I would clearly head somewhere else. There are lots of people who can provide the service. But so what will I be paying for? What is, if I make a stock trade with you, if I buy a mutual fund, is there a fee for buying and selling? And then, more important, what is the fee of each fund? And they, if you're asking them this, if you're talking about specific funds, and they will probably tell you instead of if they realize that you're going to go look it up on Morningstar anyway, that they actually lose something by not telling you. And then you can say, I have read that low fee funds do much better than high fee funds, and why should I? What's so special about this fund that charges a higher rate? Now, some of them may charge you to do a financial plan at the outset, and it's important to know if they do that. And I just want to broaden it to financial planners for a second. We're talking about brokers. The best financial planners to recommend are fee-only financial planners. So they get no commission on anything, and they have no conflict of interest, and they will either charge you for drawing up a plan, or they will charge you by the hour. They will charge you some rate that has nothing to do with what you end up buying. And I just think that's a terrific setup. That's sort of the ideal setup because you're paying them for their expertise, but you're not. They have. It's hard. Talking about Wolf of Wall Street, it's hard for some human beings to resist the idea that if I sell the client this, I make $3,000, and if I sell him that, I make $10.
Right.
If it's a glaring difference, if you get paid a huge amount for putting someone in an annuity, especially if it's annuity, sold by the employer. So don't be bashful about asking the questions, and even in some cases, like with a financial planner, you could, even if it's a flat fee, try. Maybe you can lower the fee by doing some of the like the network calculation. If that's something that they were going to do, you can take on yourself. That is just basic work as opposed to advice to even lower the fee more.
I got to jump in here. I got to ask you a question. So sure. If I have a retirement fund and I have a fiduciary and they are making trades, they're doing whatever they're doing, supposedly in my best interest. The fees, when they do these different things, I'm not paying them separately. In other words, those fees are within my original money that's in that transaction, correct? So I might not really know what I'm paying.
Right, and they have all sorts of different ways for, sometimes there's a flat annual fee, and you get, for many people, more trades included than they would ever do. And Sometimes it's a per transaction thing. Sometimes the money is taken out of the fund. You're allowed to take money out of a retirement fund for an investment expense or for a commission. I would advise people, not to do it, just because there's no tax consequence, but it just diminishes your nest egg, and I think it's better to pay when you can from outside the fund. But it's the vast majority of people, I think, just wouldn't have a clue what they're paying, and that doesn't mean they're necessarily being robbed blind, but maybe there's a better way. And just for someone who manages his or her own account, there are ways to save money over Schwab or TD Ameritrade. There's a firm called Interactive Brokers, which I own their stock. I don't work for them, and I'm in the process of moving my hedge fund to them because their rates are so low. They can be, 200 share trade can cost you $1, and the average trade of electronic broker is $8.82. So you're saving almost 90% on that trade. Now you may say it's not a lot of money, saving $7.82, but it depends how much you trade. Yeah, and they're cheaper on everything. I mean, they're a very good outfit, and but most people, they look, at, and I know myself, since I'm a relatively active trader, being a professional, that I still have personal accounts with TD Ameritrade, and I go like, why is that?
Yeah.
That's not. Yeah. I'm talking about investment fees, and I'm not, and the real answer, besides just inertia, that it's a pain to move it, is that you don't feel the fees. I mean, when it costs me $8 to make a trade, it's not coming out of my wallet. It's not even. It's just coming out of the money market fund that is at TD Ameritrade. So I never feel that someone's taking it from me. I should feel that way.
Right.
And I should say that same thing. Go to Interactive Brokers. It's $1 or $2 or maybe $3, depending on the number of shares, and you can do better. And it just takes a few minutes to switch. It's really not complicated.
All right. Now Jeff is looking at me. He just handed me a piece of paper to ask you some more questions, Andy.
Okay.
And these are good ones.
Go, Jeff.
Because I don't know what they are. But what are junk fees? We hear about that. And then how do you know if the broker is charging a junk fee?
Oh, I don't. What is a junk fee? I don't know that one.
I don't know. I've heard. Do you know what they are, Jeff?
Let me look that up.
Like when you get your phone bill, he's saying they have all these fees. Sometimes you might see these fees, but you don't know what they are. So my guess. Okay. So.
Well, I know them well from my phone. These are. The first time I say nebulous charges assessed at the closing of a mortgage. Things that are hidden in the mortgage documents, and
right. You should know what every fee is.
Right,
you should have an
explanation. And it says, and this is actually interesting. The idea behind junk fees is that at the end of the mortgage signing process, the borrower is already committed to signing the loan and will not walk away from the table. So, you have a you have a tired, motivated person who is not, for $100 or whatever, is not going to say, I'm standing on principle, I'm not going to go through with this deal.
Right.
So,
right.
But I've never been in, I see them on my Verizon phone bill, and they certainly add up. These, those aren't fees that you can negotiate, as far as I know. I mean, you can look for a better deal with a different carrier, potentially, but the phone bill fees, let me see if it, but with junk fees, I think one of the truths that they get at is that when the it's a large transaction and the fees, let's say they're $5,000, the total fees are $5,000. The 20s and 30s and 50s and $100 fees seem like a drop in the bucket, and you want to get the deal done.
The perception.
And so you're
Right.
vulnerable to
being taken advantage of.
Right.
I get it.
Because you're so motivated to close it.
Now we got about a minute before we get a break, but you mentioned Morningstar. I have no idea what that is. What is Morningstar?
Oh, okay. Morningstar.com, and you don't have to pay them any money. You can go to their website and type in either the name of the fund, or they respond better if you have the ticker symbol from the fund, which you can get just on Yahoo Finance by typing in the name of the fund. And they will give you a wonderful free report on it, which talks about its performance versus the S&P, and on the first page it has its fees, and so it makes it very easy to compare how different what they cost, how they performed, and so you have that information, and you and they're totally their numbers are absolutely unbiased. So, I mean, they recommend some funds over others, but there's no...
It's a good resource, in other words.
Yeah. The only thing that's wrong with Morningstar is, they have 5-star funds, and they which have done the best in a recent period, and studies have shown you don't really do better buying the 5-star funds because performance of many mutual funds is cyclical, and it's biotech has had a great 5 years, so a lot of the biotech funds are going to have, a lot of the health sciences funds are going to have 5 stars, and that may or may not mean they're going to have a good 5 years.
I gotcha.
Next 5 years.
I'm going to ask you to stay on the line. We're just going to go to a quick break, so don't go anywhere.
Okay.
Are your credit reports a mess? Are debt collectors hounding you? Maybe you're in foreclosure or headed towards foreclosure and don't know where to turn. It's time to stop panicking. Take back control of your life. Make the first step by calling Credit Education Consultants today at 813-500-6064. That's 813-500-6064. Mention the word radio for a free 15-minute consultation. Don't delay. Call today.
Do you suffer from back, neck, or body pain? Do you suffer from migraines or have jaw or face pain? Has conventional medicine failed you? Were you injured or in an accident? Call chiropractic physician Dr. Dan Maddock at 813-935-1664. Dr. Dan has helped thousands of patients gain relief for more than 30 years. Dr. Dan is caring, gentle, and takes his time with each patient. He's also a past president of the International Craniopathic Society, a special certification of only 300 chiropractors worldwide. Dr. Dan helps patients from the neck up and the neck down. Dr. Dan accepts most insurance plans. Don't continue to live in pain. Call 813-935-1664 today. That's 813-935-1664 and get on track to better health.
Our highly competitive and hectic world is fraught with dishonesty and challenges. Critical decisions must be made on a daily basis with accuracy when substantial assets are at risk. When you are confronted with a decision point involving opportunity and risk, consult with Sharpline Investigations, statewide experts in due diligence, investigations, and litigation support. Sharpline's professionals work with clients to conduct interviews, deep background investigations, and develop facts and intelligence related to litigation. When circumstances require confidential and expert fact-finding, turn to Sharpline Investigations, the statewide leaders in investigations and risk mitigation. Visit sharplineinvestigations.com or call 855-394-0042.
Welcome back. I've been speaking with Andy Feinberg, and we are talking about, what you should know about saving money on high investment fees, because you really should know what you're paying. Now, Andy, I want to kind of finish up this topic before I go on to the next, but can you explain what is a fiduciary?
Okay. I am a fiduciary as a hedge fund manager, and I have to do things that are in the best interests of my clients. I cannot do anything that is in my interest as opposed to theirs. And I'll give you an example. If I suddenly like a stock, I decide, Microsoft, now is the time to buy. I cannot buy that in my own account first and then buy it in the hedge fund. That's called front running, and you're not allowed to do it. If it's coincident, if I buy Microsoft, if I decide to buy something, and 6 weeks later decide, I should buy it for the fund also, that's okay. It's when it's an hour before that people look upon it. Unfortunately, stock brokers are not fiduciaries. Their standard is that they have to recommend investments that are suitable for their customers. That's a nice standard, but it doesn't, in my opinion, it doesn't go nearly far enough, because it can still recommend investment X, which is much more expensive than investment Y, even when they hold the same stocks, even when they accomplish the same things in the portfolio. So, and there's been all this the attempt to change the broker stand to make them fiduciaries, and there's this pushback from the industry, which is really unfortunate. So in an ideal world, it's nice to do business with a fiduciary. That doesn't mean their advice is any better, but it means their advice, they're looking out for you, not be acting with a conflict of interest that pits them against you.
Well, that leads me to ask you the next question, which is, when do you know that it's time to get rid of the person that you've hired? Are there signs?
There are a couple signs, I would say. One is if they don't take seriously your discontent, if they don't explain what's been going on, why, for instance, your investments have been lagging the market. If they don't, people who make mistakes should apologize in every part of life. If they, say, well, we bought Tesla and now it's down 100 points.
We screwed up.
Yeah, right. Or if they say that everything will come back, because not everything comes back. One of the hardest things in investing is to know when to cut your losses. And Tesla is a great example of it. It's fallen many times, but now it's up high again. And so they have to take your concerns seriously. They have to also explain what they're doing. Advisors and funds aren't going to beat the market all the time. There are cycles for utility stocks did great last year, and now rates have been rising the last few weeks. They're getting killed. So the guy who recommended utilities last year looked brilliant, and now he's looking like a dunce. So
it's a tough business. I mean, you're basically gambling in a certain respect on what's going to work and what's not.
Right. And the other is that if you feel that since we're talking about fees, if you're paying a good deal for advice that's not producing anything that's particularly helpful, sometimes you might think that you could do it yourself, and you might be right. And you should also know before you fire anybody whether you need hand-holding from someone. Maybe you're not getting it. It's legitimate to expect some hand-holding from someone, which can be a really valuable thing if the market's getting killed and they say, stay the course, a lot of things are still, they keep you from selling when things are down. That's a good thing, because historically, selling every time the market collapsed is a really bad strategy.
Right.
Really, you should be buying when the market collapses.
Yeah.
And so that, either their advice is bad, or their concern is not adequate, or their fees are too high, or some combination of all of those. And I have one friend who's a client who finally took her money away from her cousin. And basically her last reason for having the money with him was because he was her cousin. Mm-hmm. And it was so hard to say, this is just not working out. And I think, realize even if they're not your cousin, there is an emotional connection. It is hard to fire somebody, especially when money is a very powerful, intimate thing. So you've got this deep connection, whether you know how deep it is or not. And so, but just try to sit down without any bias and see what it's costing you and what you're getting that you couldn't get at, one thing we haven't told you is like robo-advisors, these electronic, and they're quite reputable. They will, for very little money, do a plan and use ETFs and get you an allocation that is appropriate for your age and your income and your retirement prospects.
Okay.
And they don't do any hand-holding, but for very little money, they can do the same kind of diversification that a financial planner would provide or that a broker might provide. And the question is, and they're attracting a lot of young people. A lot of the millennials are going, well, this makes sense to me. The fees are really low, and it's done by a computer, and I can relate to computers.
So that works. That works. So I guess it comes down to your own needs, because a lot of people are not financially savvy when it comes to investments, and they're going to need the hand-holding no matter what. And that's when you have to find the fiduciary that's going to offer you that. And then you're going to have the people that maybe are more knowledgeable about it and want to do something like Vanguard themselves. And then you're going to have the millennials who say, I get this, I'm doing it on the computer, maybe I'm studying it in school, and now it makes more sense. So you kind of got to pick what's right for you and feel good about it.
That's right. And there's, some people, I haven't seen survey of how people feel about when they have a robo
right.
a robo advisor, which means not really an advisor.
Okay.
But it should, for some people, it should work terrifically, because it addresses the fee issue, and as long as they're not telling people that we'll beat the market by X amount because our back testing shows that this would have worked. You can't guarantee returns to anybody, no matter what your strategy is. And in fact, it's not legal to guarantee returns to a client. Unless if you're giving them a portfolio of bonds with a particular coupon rate and you're going to hold them to maturity, you can say it is likely that the return will be 5% a year over 15 years. But
everything else, no, you can't.
Right.
All right. Well, hang with us. We have one more segment. We're going to talk a couple of different things in that last segment. Be right back.
Our highly competitive and hectic world is fraught with dishonesty and challenges. Critical decisions must be made on a daily basis with accuracy when substantial assets are at risk. When you are confronted with a decision point involving opportunity and risk, consult with Sharpline Investigations, statewide experts in due diligence, investigations, and litigation support. Sharpline's professionals work with clients to conduct interviews, deep background investigations, and develop facts and intelligence related to litigation. When circumstances require confidential and expert fact-finding, turn to Sharpline Investigations, the statewide leaders in investigations and risk mitigation. Visit sharplineinvestigations.com or call 855-394-0042.
Do you suffer from back, neck, or body pain? Do you suffer from migraines or have jaw or face pain? Has conventional medicine failed you? Were you injured or in an accident? Call chiropractic physician Dr. Dan Maddock at 813-935-1664. Dr. Dan has helped thousands of patients gain relief for more than 30 years. Dr. Dan is caring, gentle, and takes his time with each patient. He's also a past president of the International Craniopathic Society, a special certification of only 300 chiropractors worldwide. Dr. Dan helps patients from the neck up and the neck down. Dr. Dan accepts most insurance plans. Don't continue to live in pain. Call 813-935-1664 today. That's 813-935-1664 and get on track to better health.
Are your credit reports a mess? Are debt collectors hounding you? Maybe you're in foreclosure or headed towards foreclosure and don't know where to turn. It's time to stop panicking. Take back control of your life. Make the first step by calling Credit Education Consultants today at 813-500-6064. That's 813-500-6064. Mention the word radio for a free 15-minute consultation. Don't delay. Call today.
Welcome back to the show. My guest is Andy Feinberg. He is the CJA hedge fund manager, and he's also a columnist for Kiplingers Finance. And Andy, in the last segment, I want to talk about credit cards. You know, credit is my topic. I know it's yours. How can you save, and how can you keep up with new offers?
Well, on saving, one of the and some of these things I've done with late fees, for example. I think twice I was late with my payment, and I called them up, and I got the late fee waived both times. And for many customers, especially good customers, and they also tend to do this more with older customers, but it's there was a study done that 90% of those who asked got late fees waived, yet only 28% of the people surveyed made the call to do that. And it also applies to a lower rate. You can, before you switch to a different card, which may be the right thing to do, you can ask your existing credit card companies, and 60% of the people who asked for a lower rate got it, but only 23% asked. So that's one of the places to start. Now, it doesn't mean if you're paying 15% that they'll knock it down to 5%, but it's certainly something to think about. And before you leave, see how low they'll go. And especially if you've done a good deal of spending and you've been good at paying off your credit card. I think there are ways. I'm not an expert on keeping up with the latest offers. I mean, you can look. If you go to places like bankratemonitor.com, I know that's a good place to check rates on savings accounts, and I know they used to have credit cards listed as with good interest rates. Now, sometimes the interest rate is a teaser rate. It may only apply for 6 months or a year, and so you need to find out. Since we're talking about fees and interest costs are related to fees, like what the rules really are. And a lot of people, just as in real estate, in the before the crash, a lot of people had these teaser rate mortgages, and teaser rate is a very tricky term because it can help you if you play it right.
Right.
And if you're on top of your game, but it can really, come back and bite you if and what happened in the bubble is that people were going, oh yeah, I've got a 3% mortgage, and I can handle the payments. But then it ballooned.
That's right. They didn't look at the big picture.
Right. And so, if you have advice on where to go for low credit card rates, I know there are.
Well, Bankrate, I believe. Yeah, Bankrate, I believe, does still show you the comparisons for it. Now, one of the things I want to mention with the late fees, okay, if you have high credit scores and I think in all the years I've had credit cards, I've been late once. I just know when everything is due. I pay everything off early. As a matter of fact, I usually prepay my unsecured credit cards, so I owe them no money, but I keep very high FICO scores as a result. So if you have a good track record and you're not habitually making late payments, and you call up because one time something happened, yeah, they're gonna take it off. But if you are an abuser and you're always late, well, then you're in trouble. Now you've also destroyed your FICO scores on top of it.
Right. So this is not right. We don't want anyone to take away that, it's no big deal if I'm late on my payment because I'll just call and they'll take it off. Because it is, it truly is when you can at least say, and in my case, it got somehow it got put on the bottom of a pile, which I didn't look at until too late.
Right.
And by the way, I'm calling you. My check. I mailed my check an hour ago. And, and that was true. So it's.
Yeah, I don't wait till anything comes in. I don't like to owe anybody anything. Now, I can just tell you, coming from my background, I have over 800 FICO scores. But what I do is I only have 2 credit cards, a MasterCard and a Visa, and I've had them both for about 16 years. My interest rates are so low you probably would not believe it because that's how low they are. Most people don't fall into that category, but what happens is sometimes they go, well, I see this other credit card offer coming and it's a lower interest rate. So what they do is they cancel the credit card they currently have, which then they have to pay off, and they open a new one. And that's a double FICO score hit because when you close an account, it hits your FICO scores. When you apply for credit, it hits your FICO scores. But if the interest rate is better and you want to do a balance transfer, keep the card that you had. Don't close it. Do the balance transfer. You're just going to get a few points off for applying for new credit if you get accepted into that, and then you'll just pay off the lower interest rate card. And that way you don't hit the FICO score so hard. That would be my advice.
That's a great point, and along with that is when you have a lot of inquiries, when you're asking about getting credit, that ends up dinging your FICO score because FICO, they think, gosh, you may be needing to borrow a lot of money, and why do you need to borrow so much? When all you may be doing is looking for lower interest rates. So it's better to narrow down what you're targeting for the lower interest rate and do some research before you start the application process.
Right, and before you even do the balance transfer, call your existing bank and say, hey, I got an offer for X amount of interest. Can you match that? I'm a long-time customer of yours. And a lot of times they will. Again, you have to be in good standing, I think, with that.
Right.
And then,
but good standing doesn't mean perfect standing. I mean, it can be, it comes down to, are you the kind of customer they want to keep, and do they have the flexibility to adjust their offer? Now, of course, they don't want everyone knowing that they can avoid all late fees, that they can lower their interest rate. I mean, they have a business to run, but
they want to make a profit. But if you're in good standing, not perfect but good, a lot of times they'll work with you. Now, I wanted to ask you, what's your opinion on loyalty or rewards cards? Because my understanding is when you're actually paying a little bit into that interest rate, nothing is free. So a lot of times those loyalty and reward cards are actually at a slightly higher interest rate than if you took one where there's no loyalty or rewards.
Right. Now I have a loyalty card. I don't pay interest on it. I just always pay my bills. So it can, in some cases it doesn't apply. But you're right. Those are rarely going to be the best deals on interest rate if you have to carry a balance, if you're looking to transfer a balance.
Right.
It may not be the first place to look. But what I hope someone takes away from this whole discussion is how it's worth trying to first find out what you're paying in fees. Negotiate. There are areas to negotiate, And in the case of products sold, you can even get them to give you a different product because you object to the fees of the product they're trying to sell you, and it can be one that actually serves you much better because it's very similar but it's cheaper.
Right, but a lot of people don't know that a lot of people don't know you can even ask. They don't think it's negotiable, but what you're saying is yes, a lot of times it is.
Right, and they're once they either have your business or think they're about to get your business, they would be foolish not to at least entertain the idea of plus with some they'll learn that you're a smart consumer, and they will not try to take advantage of you because they'll figure that you'll see what's going on and that you will leave. So that I left out when you said why switch. If you think someone is truly taking advantage of you in the sense of getting you the higher fee products rather than lower fee products, and since they don't have to be a fiduciary, they're not acting as one, that's a good reason to leave. And
right.
When they're just
I think I want to just point out one more thing. I think you have to watch also for predatory credit card offers. Because a lot of companies will do that tease, or I call it the bait and switch. They'll say you're pre-approved, and what they do is they target consumers that have a lower FICO score that are maybe on the edge. And the reason they do that is they know that if they do actually qualify, which is then a hard hit on your you're getting the points off on your inquiries, they're going to be paying a tremendous amount in interest rates. So you have to be aware of those things too. We're going to wrap it up in just a couple of minutes, but do you have any last statements that you would like to say to our listeners?
Well, I would say, and you and I were talking offline about this, that even with real estate, you're probably not likely to get a break on the real estate commission, but it can be worth asking, and it won't be taken, I think, as a great offense. But the other is just assume and don't feel bad about it that we're all paying more in fees than we have to. And I confessed during this talk that with my discount brokerage, I'm not getting the best deal I could get. And not that life has to be about squeezing every penny out of every situation, but when you can lower your costs in an easy way, and with investing, it can have such enormous impact on your lifetime accumulation of wealth, whether you're paying on the low side or paying on the high side.
Yeah, I think you're right. And with the real estate, I think where you might have a better chance at negotiating is if you have multiple properties. I think that would probably work better. But I want to thank you so much for joining me again. And would you give out your
pleasure.
Thank you. Would you give out your contact information in case somebody wants to get a hold of you?
Okay, it's A Feinberg, Feinberg at cjapartners.com.
Great.
And I welcome any emails.
Great. Thank you very much, Andy. And join us every week for a new Half Empty, Half Full Consumer Advocacy Talk radio show. Learn something new every week and get smarter faster. Be safe.